Welcome to Solidarity Spotlight, the place where we share with you bleeding edge stories. I'm your host, Solidarity. Let's discover what's happening today in blockchain. The cryptocurrency market continues its dynamic evolution as Bitcoin hovers near the $120,000 threshold, a psychological milestone that underscores the asset's sustained upward trajectory despite periodic volatility. This price resilience coincides with renewed institutional interest in alternative cryptocurrencies, evidenced by Nasdaq-listed companies strategically accumulating assets like Binance Coin as treasury reserves, a significant shift from earlier Bitcoin-exclusive approaches. Such moves signal growing corporate confidence in the broader digital asset ecosystem, potentially accelerating mainstream financial integration. However, derivatives markets show escalating leverage across altcoins, with open interest reaching record highs above $40 billion, creating fragility that could amplify downward swings if sentiment shifts abruptly. Industry observers note this leverage-driven growth contrasts with previous cycles fueled purely by speculation, though the sustainability of such momentum remains uncertain amid regulatory headwinds and macroeconomic pressures. Ethereum has achieved a notable milestone by surpassing Bitcoin in weekly spot trading volume for the first time since mid-2024, recording $25.7 billion versus Bitcoin's $24.4 billion according to on-chain analytics. This reversal suggests shifting capital allocation patterns as institutional and retail traders increasingly rotate into Ethereum and its ecosystem tokens, possibly anticipating developments in scalability solutions or Layer 2 adoption. Supporting this thesis, blockchain sleuths identified 7 newly created wallets, accumulating over 466,000 ETH, worth approximately $1.7 billion within a short time frame, a concentration of buying pressure typically associated with sophisticated entities preparing for strategic positions. Such whale activity could foreshadow heightened network utilization, though it also raises questions about market centralization risks that might trigger volatility if large holders execute coordinated exits. Regulatory developments are reshaping market structures, exemplified by Coinbase's launch of CFTC-regulated perpetual futures contracts for U.S. retail traders, a landmark shift providing domestic access to leveraged derivatives previously confined to offshore platforms. These nano Bitcoin and Ether contracts feature 10 times leverage and 5-year expirations, addressing long-standing demand for compliant instruments while potentially redirecting trading volume from unregulated venues. The timing aligns with the recently enacted Genius Act, which establishes clearer stablecoin frameworks, creating synergistic conditions for institutional participation. Market impact could include reduced systemic risk through improved oversight, though the availability of high-leverage products may also encourage speculative behavior that magnifies losses during corrections, particularly among inexperienced participants. Tokenization of real-world assets advances through strategic partnerships like Multibank IO and Fireblocks, collaborating to digitize $10 billion in commercial real estate, initially focusing on high-value properties such as the Ritz-Carlton residences. This initiative leverages blockchain's fractional ownership capabilities to democratize access to illiquid asset classes while introducing programmable revenue distributions. Simultaneously, Brazil's VERT fund management firm tokenized $130 million in agribusiness receivables on the XRP ledger, enhancing transparency in agricultural credit markets that contribute significantly to national GDP. These developments validate blockchain's utility beyond speculative trading, potentially attracting sustained capital inflows from traditional finance sectors seeking operational efficiencies. However, scalability limitations and regulatory ambiguity around tokenized securities could impede near-term adoption at projected volumes. Geopolitical tensions intersect with cryptocurrency as investigative reports reveal Russian entities exploiting Kyrgyzstan's licensing framework to evade sanctions. After Kyrgyzstan passed its On Virtual Assets law in early 2022, crypto transaction volumes surged to $4.2 billion within licensed platforms, with forensic analysis indicating ties between Kyrgyz-registered exchanges and sanctioned Russian paramilitary groups. Notably, wallets linked to the Rusich group utilized ruble-pegged stablecoins to procure dual-use goods, highlighting vulnerabilities in emerging regulatory regimes. Such exploitation risks provoking stringent, international countermeasures that may limit legitimate cross-border crypto flows, particularly affecting Eastern European markets, where compliance infrastructure remains underdeveloped. Market stability could suffer if jurisdictional cracks enable systematic sanctions evasion, inviting coordinated crackdowns from Western financial authorities. Stablecoin dominance faces pivotal realignment as Tether announces renewed efforts to penetrate the U.S. market. Following the Genius Act's passage, CEO Paolo Arduino outlined plans for institutional-focused USDT applications in interbank settlements and trading, a strategic reversal after the company's 2021 exit from U.S. operations amid regulatory penalties. With USDT's circulation exceeding $162 billion, this reentry could intensify competition with Circle's USDC, particularly in payment corridors where regulatory clarity now exists. Market impact might include improved fiat crypto liquidity stateside, though Tether's historical reserve controversies could resurface as scrutiny intensifies, potentially triggering short-term volatility in stablecoin-pegged trading pairs during the transition. Solana's technical trajectory progresses with developers proposing SIMD 0286, which aims to increase network capacity by elevating block compute limits from 60 million to 100 million units, a 66% expansion following earlier successful upgrades. This optimization targets congestion relief amid growing demand from decentralized applications and NFT platforms, positioning Solana competitively against Ethereum's scaling roadmap. Validators advocate cautious implementation through rigorous testing to prevent instability, recognizing that throughput enhancements could attract more developer migration if executed reliably. Such technical strides may reinforce investor confidence in Solana's ecosystem tokens, though competing chains like Monad present alternative scalability solutions that could fragment market attention. Legal precedents emerge from a federal court ruling that MIT-educated brothers must face trial for allegedly defrauding MEV bots of $25 million. The defendants exploited Ethereum transaction queue vulnerabilities to manipulate automated trading algorithms, employing a multi-step strategy involving validator manipulation. Judge Jessica Clark rejected dismissal motions, establishing that novel crypto exploitation methods remain prosecutable under existing wire fraud statutes. This decision sets crucial boundaries for permissible blockchain research activities, potentially deterring white hat experimentation, while offering legal recourse against quant-based exploits. Market implications include possible short-term reduction in MEV bot activity as operators reassess strategy vulnerabilities, slightly decreasing liquidity in arbitrage-dependent trading pairs. Binance Alpha expands token accessibility through its Aspecton listing, featuring an exclusive airdrop distributing 125 ASP tokens per qualifying user in exchange for platform points. The phased distribution mechanism employs dynamic eligibility thresholds to manage participation velocity, reflecting sophisticated token launch design. Such exchange-led initiatives democratize early-stage project exposure, but may dilute token value through concentrated initial distributions, posing volatility risks if recipients engage in immediate profit-taking. Meanwhile, QuitMiner's mobile application simplifies crypto mining participation using AI-optimized cloud resources, targeting passive income seekers with promises of 4% daily returns. While lowering entry barriers, such models face sustainability questions, given fluctuating mining rewards and energy cost variables. A dormant Bitcoin wallet containing 3,962 BTC, $468 million, reactivated after 14 years of inactivity, triggering blockchain analytics alerts, but causing negligible market disruption. Historical patterns indicate such movements rarely induce sustained selling pressure, as holders typically transfer between cold storage solutions rather than liquidate. This event highlights Bitcoin's maturing supply dynamics, where long-term holder conviction appears resilient, even against macroeconomic uncertainties. The absence of panic selling following the transfer suggests deepening market confidence in Bitcoin's store of value proposition, potentially reinforcing its perception as a hedge against currency debasement during geopolitical strife. That concludes today's Blockchain Spotlight. I would love to know your thoughts. Thanks for listening, and don't forget to follow me for more spotlights. See you next time.